Over a 20-year period, roughly 9 out of every 10 actively managed U.S. stock funds fail to beat a plain index fund, not the bad ones, not the cheap ones. 9 out of 10 of all of them, including the ones with famous managers and impressive sounding names, beat. So if the pros can't consistently beat the market, why does almost everyone still think paying for expert stock picking is the smart move? Today we're putting a hypothetical $100,000 into each strategy, running it for 30 years, and showing you exactly where the difference comes from. It's a story of fees, taxes, and a statistical trap almost nobody talks about. By the end, you'll know exactly how to think about your own portfolio. Here's the scenario, and we'll keep it clean so the math is easy to follow. Let's imagine two paths for your money. On side A, you invest $100,000 into a low-cost S&P 500 index fund and you leave it alone for 30 years. On side B, you invest that same $100,000 into an actively managed large-cap U.S. stock fund, one run by professional analysts whose entire job is to pick winning stocks and beat the market. Same starting capital, same 30-year time horizon, same general type of investment, U.S. large-cap stocks. The only difference is who's making the decisions. A passive computer algorithm or a team of highly paid experts. So, quick gut check. Before I show you the numbers, which one do you think wins after 30 years? What's your instinct tell you? Just make a mental note of your guess, because I want you to see if the final gap surprises you. Here's what most people get wrong about this debate. They assume it's a fair fight between smart stock pickers and boring average returns. It's not. Once you see the actual mechanics of fees and taxes compounding over decades, you'll understand why this isn't really a debate about skill at all. Let's start with the active fund, since that's the one most people are sold on first. The pitch for active management sounds completely reasonable on the surface. Pay a professional to analyze companies, avoid the losers, overweight the winners, and beat a dumb average that just buys everything. And to be fair, some active managers genuinely do beat the market, especially over shorter stretches. A hot fund manager can post 2 or 3 great years in a row and generate real buzz, real headlines. If you had put money with the single best performing large cap fund of the 2010s, you would have absolutely crushed the index. That success story is real, and it's exactly why active management has remained a multi-trillion-dollar industry. Active funds also make a specific claim that sounds really attractive: downside protection. The theory is that a skilled manager can see a crash coming and move to cash or rotate out of overvalued sectors before they fall. In theory, that means smoother returns and smaller losses during a bear market. Pause for effect. But here's the catch. That skill has to be paid for every single year, whether the fund beats the market or not. The average actively managed large cap fund charges an expense ratio of roughly 0.6% to 1.0% per year. Let's call it 0.8% for our purposes. Now compare that to a typical S&P 500 index fund, which charges somewhere between 0.03% and 0.15%. Let's use 0.05%, that gap. Let's call it 0.75% a year. It doesn't sound like much. But fees don't just take a bite out of your return once. They take a bite out of your return, and then they take a bite out of the money that bite would have earned every single year for decades. That's the part we need to actually calculate. On paper, beat the market sounds like the obvious goal. But let's look at the other side of the story. The index fund's entire pitch is almost embarrassingly simple. Don't try to beat the market. Just buy the market and pay almost nothing to do it. So let's run the real numbers on our $100,000. The S&P 500's long-run historical average return is about 10% annually. At a near-zero fee of 0.05%, your index fund effectively captures almost all of that. Over 30 years, that $100,000 grows to roughly $1, 745,000. Now let's make the fee drag concrete. Independent research firms that track this, most notably the SPIVA scorecard published by S&P Dow Jones Indices, have found that over 15 to 20-year periods, somewhere around 85 to 90% of actively managed U.S. large-cap funds underperform their benchmark index after fees. It's not because every manager is bad at picking stocks. It's because the fee, plus the fund's trading costs, plus the taxable capital gains from frequent buying and selling, create a headwind that's brutally hard to overcome year after year, decade after decade. So let's be generous to our active fund. Let's say its managers have the exact same underlying stock picking skill as the market average. But after its higher fees and tax drag, the net return comes out to about 7.5% annually, That's actually right in line with what long-term studies show for the average active fund. So we run that same $100,000 for 30 years at a 7.5% net return. That comes out to roughly $875,000. Let that sink in. $1 745,000 for the index fund versus $875,000 for the active fund. That's a gap of nearly $870,000 on the exact same starting amount, the exact same 30 years, and roughly the exact same types of stocks. The index fund isn't just a little ahead here, it's nearly double beat. That's a genuinely uncomfortable number if you're currently paying a management fee. But before you assume this settles the debate completely, there's a deeper reason this happens that most people never hear explained. And it's not really about fees at all. Here's the aha moment. Most people assume the problem with active funds is simply that the managers aren't good enough. Pick a better manager, the thinking goes, and you'll get the outperformance. That assumption is where almost everyone gets this wrong. Here's the uncomfortable truth. Collectively, active managers are the market. Every share of a stock that one manager buys, another investor, often another active manager, has to sell. Before fees, the entire universe of active managers, taken together, mathematically must earn the market's average return, because their combined trades literally make up the market. Some will beat it, some will lag it, but the average active dollar before costs equals the market average by definition. Once you subtract fees, trading costs, and taxes from that average, the net result for the average active investor has to fall below the index. It's not because of bad luck or bad managers, but because of simple arithmetic. Beating the market isn't a skill problem for the industry as a whole. It's a cost problem. Now here's the second layer, and it's the part that really flips people's assumptions. Past outperformance barely predicts future outperformance. Researchers who track this have found that of the funds that rank in the top 25% of performers in one 5-year period, only a tiny fraction stay in the top 25% for the following 5-year period. It's close to what you'd expect from random chance. So the strategy of just find the good active manager doesn't actually work reliably. The fund that looks great on a 5-year chart today has almost no statistical edge in predicting who wins the next 5 years. You're not really choosing skill. You're often just choosing whoever got lucky recently and then paying a premium fee for the privilege of chasing that luck. So which one wins? Here's a framework. 3 questions in order. Question 1. What account is this money in? If it's a regular, taxable brokerage account, the gap gets even wider than what we calculated. Active funds tend to have higher turnover, which triggers capital gains taxes you have to pay, even if you never sold a share yourself. Index funds are dramatically more tax efficient. For a taxable account, that tips the scale toward index funds even harder. Question 2. What category of fund are you even comparing? Large cap US stocks, like the S&P 500, are the most heavily researched, most efficiently priced market on earth. That's why it's so hard for any manager to consistently find an edge there. In smaller, less followed corners of the market, like some small cap or emerging market funds, skilled active managers have historically shown a somewhat better track record. The core US stock market is the worst place to pay for active management. Niche corners are where it's at least a fair debate. And question 3. Do you want to invest or do you want a hobby? Some people genuinely enjoy researching companies and picking funds or stocks. And that's fine as long as you're honest about what it is. If that's you, a common, sensible structure is a core satellite approach. You put the large majority of your long-term money, say 80 to 90%, into low-cost index funds as your core. Then you set aside a small slice, maybe 10 to 20%, as your satellite for active picks you want to research and follow. That way the bulk of your wealth compounds efficiently and you still get to scratch the itch. My honest, no hedging take is this for the core of your retirement savings. Your 401k, your IRA, the money you're not actively excited to research every week. Your default should be low-cost broad market index funds. That's not a compromise. Given the fee math and the data we just walked through, it's the statistically favored outcome for the vast majority of investors over any real-time horizon. You don't have to beat the market. You just have to not pay someone to lose to it for you. So think back to your guess from the beginning. Did the math match your instinct, or did that $870,000 gap surprise you? It's a powerful illustration of how small, seemingly insignificant fees can carve out a huge portion of your future wealth. If you found this breakdown helpful, I hope you'll follow the show for more deep dives into the numbers that actually matter for your money. Thanks for listening.